Okay, Assalamualaikum and a very good morning to all. Okay, this week we will move to our brand new chapter, which so called as international trade and investment. And as you can see right here, this is our third chapter according to our lesson plan. Okay, and what we are looking for this chapter, okay, first thing first, we will go for the international trade, and the next one is more toward the international investment, okay, for the second half. Okay, and this is our learning objective. Okay, as you can see right here, uh, we will get to know about the motivation for international trade. Okay, why most of the countries go for this particular international trade. Okay, summarize and discuss the difference among classical country-based theory of international trade. Before we go further on this particular international trade activities, we should differentiate between classical country-based theory. This one is a bit tricky part. Okay, use the modern firm-based theory of international trade to describe global strategies adopted by the businesses. Okay, and we also categorize the different form of international investment. Okay, and explain the reason for foreign direct investment or FDI, and summarize how supply, demand, and political factors influence the FDI. This one is more toward the international investment part. Okay, for the second half. Okay, first thing first, what we have under this particular international trade and the world economy, okay, the definition of the trade itself. Okay, perdagangan. Okay, what is actually trade? Okay, voluntary exchange of goods, services, asset, or money between one person or organization and another. Okay, this one is more toward voluntary exchange. This one will uh, be considered as trade activities. Okay, this is how we define trade or layman term, like I did say. Okay, what is some of the basic trade activities? Export and import. Okay, so this is what we have under trade. And when it comes to international trade, okay, trade between resident of two countries, that particular good and services must be exchanged abroad. Okay, mean cross country. This what we have under international trade, like Malaysia with Thailand, okay, Malaysia with Singapore, Indonesia. This what we have under international trade. The good must be cross border of the countries. Okay, when it comes to the resident, as you can see, there is a word resident. Okay, resident can be in the form of individual. Okay, can be in the form of company, in the form of country itself. So this what we have under the trade between firm between two countries. Okay, between individual of two countries. This one is at least. Okay, so what we have under international trade, okay, that good must be cross border, and that particular transaction is between these two residents. Okay, why does international trade occurs? Okay, both parties to the transaction benefit. So this is what we are going to see. Okay, because first thing first, we must have buyer and seller. Okay, uh, when it comes to the buyer itself, it demand. Okay, it demand goods. Okay, and suppliers supply goods. Okay, when it comes to this particular mutual transaction, then international trade will occur. Okay, example. Okay, for Malaysia we want to buy coffee. Okay, from Indonesia. Okay, and Indonesia will supply coffee to us, and Indonesia also want to buy goods from Malaysia. Example, uh, what we so call as tea. So this kind of two goods, okay, will be exchanged. Okay, that's what it's when it comes to the trade transaction. Okay, export spark additional economic activity because before this we only focus on domestic activity. I mean buying and selling activity only inside the country. Okay, when it comes to export, you have to produce more goods. Okay, kena uh, produce extra goods. Okay, because export you need to produce goods. Okay, and you are actually selling good to the other parties. Okay, mean when you export, you have to what we shall call as produce extra. Okay, and it also will improve competitiveness between companies. Okay, or countries itself. Okay, when it comes to competitiveness, okay, it will relate with company. Okay, so what happened to the local company that import goods? Okay, when we import good, okay, it actually will compete, okay, with local goods. So if that particular good is a bit cheap, what happened to the local good? They need to cut the cost. This happen uh, if the local company did not cut the cost of the same good that being imported. Okay, so this imported good, okay, will be the champion of the good in the country. So to compete, they need to cut costs, and that happen for the local companies. Okay, to achieve this kind of competitiveness. Okay, and as you can see right here, world export keep on increasing years by years. Same go to services. Okay, because since World War Two, okay, after World War Two, okay, we have this kind of trade activities and keep on increasing between countries. They more focus on this particular import and export activities. Okay, and you can see, okay, the champion country like United States 8.7%, okay, China 12.8%, okay, as at June 2018. Okay, most country that what we so call as focus on export activity. Okay, EU itself 33.3%. And this one is a combination of EU countries and other countries. Okay, we have numbers of country right here, but the major player is here. Okay, China, Japan, Canada, US, and the EU itself. Okay, so this one is data that being supplied by the WTO World Trade Organization based on the merchandise exports. Okay, for 2017. Okay, classical country-based trade theories. Okay, as you can see right here, before we move toward the international trade operation or activities, okay, we need to know about the classical theories. Okay, so early country-based theory focus on the individual country. Okay, because we know that most of the country, okay, they try to protect their wealth. Okay, so most of the economic activities based on the single country itself. Okay, useful for describing trade in commodities. What is commodities? Commodities is identical good. Okay, example, okay, coffee can produce by Malaysia. This also can be produced by other country like Indonesia, Brazil, okay, India. This is what we so call as commodity, identical goods. Okay, same goes to the other goods like rubber, okay, palm oil, okay, tea, black pepper. Okay, this is what we so call as commodity. Okay, price is an important component of the customer purchase decision. So we will compare, okay, in term of the price itself, because you can produce the same good. Okay, so price is the winner. Okay, who actually can give lower price, okay, will have advantage in this particular trade activities. Okay, and modern firm-based theory, okay, focus on the firm role in promoting international trade. Okay, useful in describing pattern of trade in differentiated good. Okay, so basically, at least we will compare between two countries. Okay, to visualize. Okay, which country should produce the good. Okay, which country should export, which country should import. Okay, brand name is an important component of the customer purchase decision. Nowadays, under modern firm-based theories, okay, people more rely on brand name. Okay, and they have this kind of what we so call as loyalty and preference. Okay, like toothpaste itself. Okay, toothpaste. Okay, people will loyal to certain product like what we so call as Colgate. Okay, so this product they will consume generation by generation. Okay, so it's what we have under the brand name itself, under customer purchase decision. Okay, okay, so this is the first classical country-based theory. Okay, we have mercantilism. Okay, what is mercantilism? This one of the ideology uh, is intent to maximizing holding of gold and silver. Okay, so basically, okay, this theory under mercantilism, okay, their identification is more toward promoting export. Mean you produce extra good, extra quantity, but discouraging in import. This particularity will differentiate. Okay, this earlier uh, classical country-based trade theory compared to the other theory. Okay, and they're also one of the new mercantilists or what so called as protectionists for this new trade theory. Okay, which if the old theory is mercantilism, okay, and the new one that support promoting export, discouraging import, we call as new mercantilist, okay, or protectionist, because they are actually encourage export and discourage import among country. Okay, so this is what we have here under mercantilism, which okay, uh, Adam Smith. Okay, Adam Smith is one of the what's it called economists. Okay, from Scotland. Okay, which he actually opposed. Okay, this particular mercantilist theory, or we so called as mercantilism. Okay, so based on Adam Smith judgment, okay, it actually weaken a country. Okay, because you just produce okay the good extra good for all uh, industry, okay, which actually will squander a country resource. Okay, because we are not focused on certain commodities. Okay, which also reduce a country wealth. Okay, so right here Smith, under his book of Wealth of Nation, okay, advocated free trade among countries. Okay, so like he actually promote this particular what we so call as free trade. Okay, free trade, not only free market but also free trade. Okay, which enlarge a country well. Okay, and as you can see for the example, okay, Adam Smith, okay, he actually come up with absolute advantage theory. Okay, what is absolute advantage? Okay, in Malay we so call as uh, faedah mutlak. Okay, so this is the example. Okay, country level of productivity more productive than other country and less productive than other country. Okay, so this particular country, okay, we will give example. Okay, what good okay that we should import, what good that we should export. Okay, normally good that we more productive than other country we export. Okay, mean we can produce more. Okay, so we can export to the other country. And good that we less productive than other country, we import. Okay, to achieve this particular what we so call as local demand. Okay, so this what we have under export and import under countries level of productivity under absolute advantage theory. Okay, so example right here. Okay, France has an absolute advantage in the production of wine. Okay, we have two good here, wine and clock radio. Okay, Japan has an absolute advantage in the production of clock radio. Okay, how? Okay, you can see right here in terms of productivity. Okay, what is productivity? Numbers of output. Okay, that you can produce an hour. Okay, so right here, per hour. Okay, in France you can produce two wine. Okay, and for Japan, if we compare only one wine, so absolute advantage goes to France because in term of production of wine, okay, in term of productivity, okay, France is the champion. Compared to clock radios, okay, in France they only can produce three per hour. Okay, but Japan can produce more, five per hour. So right here, Japan is better in terms of producing clock radios. Okay, so under this particular uh, absolute advantage theory, okay, they will export. Okay, good that they are productive. What we so call as can be better in term of productivity. Okay, and they actually import good that less productivity. Okay, uh, of their country. Okay. Okay, what if one country has an absolute advantage in both products? Okay, so theory of absolute advantage, no trade will occur. Okay, example. Okay, both goods. Okay, is higher in terms of productivity when compared between two countries. Okay, also championed by this single country. Okay, like France. France good in wine, France good in clock radio. Okay, so there is no trade war occur. Okay, but okay, there is one other argument. Okay, this is some of the other trade theory. Okay, that oppose this absolute advantage. Then comes into comparative advantage. Okay, what is comparative advantage? Faedah berbanding. Okay, so it actually initiated by David Ricardo. Okay, which relative productivity differences. Okay, even though that particular good, okay, don't have, okay, this kind of what we so call as advantage, okay, in term of productivity. Okay, but we do compare in term of relative. Okay, relative between the countries. Okay, right here the keyword is specialization. Each country do specialize in certain good. Okay, so they will export good that they specialize. Same goes to the other country. Okay, they specialize one good and then they will trade, okay, between countries that specialize, okay, the other goods. Okay, and it actually based on the opportunity cost. Okay, of the cost of the good, okay, that being produced by the country. Okay, example right here. Okay, as you can see, okay, countries level of productivity right here, okay, is different with absolute advantage. Absolute advantage, it will depend on the productivity. Okay, but comparative advantage, it will depend on the relatively mean comparison of the two countries. Okay, so relatively more productive than other countries, we will export. If less productive than other countries, we will import. Okay, and as you can see right here, Okay, the theory of comparative advantage. Okay, if both of the what we so call as product, okay, in term of productivity, per hour, wine is 4, okay, but Japan is 1 per hour, okay, in term of production, okay. And for the other good clock radios, 6 can be produced by the France, okay, but only 5 for Japan. Okay, right here we can see under absolute advantage, okay, maybe France. But for this particular uh, comparative advantage, because comparative advantage, they intend for specialization. Okay, so you will see the relative productivity. Okay, relativity of the products. Okay, so you can see right here. Okay, you are better off specializing in what you do relatively best. Okay, here under wine, okay, we can see 4:1. Okay, so it's 4:1 can be considered as the wine itself. Okay, uh, and for the clock radio, okay, 6/5. Okay, 6:5. So right here for France, okay, the most relatively high under this particular comparison is wine compared to clock radio. Okay, so they produce more wine compared to clock radios. Okay, and for Japan, 1:4 and 5:6. So if you can see right here, if 1:4 is around 0.25, okay, so 0.25 compared to the relative productivity cloud radio 5, okay, 5/6, okay, or 5:6 is around, okay, you can see from the what we so called as calculator, okay, the what we so call as the figure can be a bit much higher, okay, much higher in term of what we so called as the uh, value itself, okay, 0.83. So 0.83 is higher than 0.25. So Japan will focus on clock radio, France will focus on wine. Okay, because 4/1 is 4, 6/5, of course, is 1.2. Okay, so right here, both country do specialize in one good. Okay, so produce and export those goods and services you relatively best able to produce. Like I mentioned, France is good in wine, okay, and Japan good in uh, clock radios, okay, and they will buy other goods and services from people who are literally better at producing them than you are. Okay, and about when we actually associate with money, okay, what happened? Okay, you can see right here. Okay, okay, this is two table. Okay, two table. One is cost of good in France and one cost of good in Japan. Okay, so what we have here, okay, cost of good in France, okay, for wine, okay, because they actually use different in terms of the currency. Okay, we have 3 euro. Okay, if actually this particular good in France, okay, made by the Japan, okay, uh, it will cost around 8 euro. Okay, 8 euro. Okay, and what we have here for the clock radio, okay, for the clock radio, good cost of good in France, okay, for the French made, okay, is 2 euro, okay, but for Japanese made is 1.6 euro. Okay, So this is the price itself. Okay, so if you are actually okay for wine, okay, is it good to import because the cost is high, €8. So that's why you will stick with your what is so called as product €3. Okay, and for clock radio, the cost is cheaper. Okay, if you import from Japan, €1.6 only. Okay, so if you want to sell €2, okay, in France, okay, you can get a profit. Okay, you can compare 2 minus with 1.6. That one is the profit if you are actually import the good and selling at the price same that you can produce in France. Okay, and same goes to Japan. Okay, based on this particular what we so call as exchange rate 1 to 5. Okay, so cost of good French made is 3 times 1 to 5. You will get 375. Okay, for Japanese made wine. Okay, for Japanese made wine, uh, €8 times 1 to 5 is 1,000 yen. Okay, so you can compare in Japan itself. If you actually import the wine from France, okay, so the cost only 375. But if you actually make yourself that particular wine, it will cost around 1,000. So right here, Japanese, they have option. Import this particular good from French and sell it to their locals. Okay, they will gain much profit here. Okay, more than around what we so called as 625 yen. Okay, they can gain profit if they actually sell the good. Okay, that they import from French. Okay, same goes to clock radio. As you can see right here, French made is 250 yen, but they actually can what we so call as make themselves only 200 yen. So right here, better they import one and they actually export this particular clock radio to France. Mean they themselves maintain this particular clock radio for the local market. Okay, so that is what we so call as some of the tips for mercantilism. Okay, absolute advantage and comparative advantage. Okay, and for this Hexia Olin, we will go further on our next lecture. Okay, so that's all. Thank you, and we meet again on our next class. Okay, assalamualaikum.